Okay, what is up, tycoons? What's up, traders? Are you guys tired of getting false charting signals? There's some stock chart indicators that you guys may want to start using to really help you guys out on your journey. So I'm going to cover a couple of those. Make sure to smash that like button, subscribe to the channel if you guys are new, and we'll go ahead and get straight into it. Now, people in nature tend to be predictable, right? Too bad the stock market isn't. Using stock charts can bring a modicum of probability in which to make trading decisions. But what happens when your charts tell you something that doesn't come true? Where do you go when the common buy and sell signals and market turning indicators, which are momentum indicators like the relative strength index, the RSI, or the moving average convergence divergence, MACD, for example, they keep giving you false signals? You dig deep and go off the grid. Now, these are two that I use in most of my YouTube videos that I put out here. So we're not actually going to cover those. We're going to cover a couple different ones. There are thousands of charting studies and stock chart indicators. The Thinkorswim platform lists more than 300, right? And so today's video is not sponsored by Thinkorswim, but it is my favorite charting platform for the stock market. And it's what I use every day whenever I'm trading. Now here we'll cover three. We're actually going to go over two actually that are a bit different than the MACD and the RSI, but worthy of attention. We're going to look at the standard deviation channel and the shaft trend cycle. Even if you don't use them for yourself, consider this an exercise in learning to uncover hard to find studies and how to use them to anticipate the potential for market moves. The standard deviation channel is the first one we're looking at here, the SDC. Now, this statistical analysis tool is normally overlaid on a price chart. To find it, select the Charts tab on Thinkorswim. In the upper right corner, select Analysis Tools, Add Study, All Study, and select the Standard Dev channel from the Studies menu. As shown in Figure 1, the SDC is composed of a middle regression line that's automatically plotted for you, as well as two other lines plotted above and below it by one standard deviation, which in statistical speak means it contains 68% of the price data. Right. And standard deviations are something that a lot of people look at. And, when it comes to institutional traders, right, and institutional analysts, market makers, hedge fund managers, different things like that, they're going over one standard deviation, two standard deviations, different things like that. Now, this indicator makes it relatively easy to spot when a stock's price action hit extremes, as well as a line that is mathematically closest to all the charted prices. Okay, so you can see here that this would be considered a buy signal because you are below the standard deviation channel. Okay, and so this is your middle regression line. And you can see here that we break below the standard deviation, and this would be considered a buy signal because it is, essentially saying that it's very oversold. And over here, you would take a look, and this would be a sell signal because we're breaking out above the standard deviation channel. Okay, and so we're higher than one standard deviation, and there's a strong likelihood that we will get some type of a pullback. So that's how you use the standard deviation channel, the SDC. All right. Theoretically, 68% of the price action falls into the SDC if both upper and lower lines are plotted one standard deviation above and below the trend line. If you increase that to two standard deviations, statistically, you'll get 95% of the price action expected to fall into the channel. Now, without getting into the mathematical complexities used to plot the middle regression line, SDC is basically a measure of how much the price has historically tended to move from one point to the next. The study's idea is that over time, prices tend to regress toward that middle line, which represents where buyers and sellers have agreed to a price the most number of times. If the price moves above the top line or below the bottom line, that price is now out of its statistically normal range. The thought is that the price is likely to fall back into that normal range. Another potential explanation is that price is starting a new trend. Referring again to that Figure 1, the yellow line is the regression line, and we take a look how the price reaches the top line, which is two standard deviations above the middle line, noted with the pink arrow. Almost as soon as the price reaches that point, it begins to move back to the middle line. The price repeats that action at the green arrow and nearly again. The idea is that because price tends to regress back towards the line, bullish and bearish potential trade opportunities may present themselves at extreme points of the channel, right? And so that's kind of what we took a look at here and really went over for you guys and broke down. Now, the shaft trend cycle is the next one that we're going to look at. Although the name may be foreign to you, the STC combines two well-known indicators, the MACD and the stochastics. Because these two indicators are typically used together, the STC gives you the chance to see and learn the benefits of each study while looking at a single output. The main idea is to combine the benefits of trend and cycle indicators and minimize their drawbacks, such as lags or false signals. The STC's main goal is to estimate the price prediction and potential market turning points. Technically, the STC is an oscillator that moves between 0 and 100 and is calculated as a double smooth stochastic of the MACD. In trending markets, the STC is expected to move up if the market trend is accelerating. In trending markets, the STC is expected to move up if the market uptrend is accelerating, and likewise, accelerating downtrend should push the oscillator down. During sideways markets, the STC attempts to identify potentially oversold conditions when it reverses after falling below 25, or possibly overbought conditions when it turns down from above 75. In short, many chartists use the STC in trending markets to try to determine if the trend is growing or is in a sideways market and might indicate a breakout. Right. And as I mentioned, it combines two popular indicators, the MACD and the stochastics. At the beginning of the chart, the price is not trending in any particular direction, but you see a pattern begin and the STC breaks below the oversold line. All right. So that's kind of what we're looking at here. Once the indicator reverses and moves above the oversold line at 25, a buy signal is triggered. Next, after crossing above the top line, the overbought line, the indicator crosses back below that line, the first red arrow. This indicates the trending market has run out of bullish acceleration and may be at an exit signal. If the signal lives up to expectation, you'd expect to see a downtrend at this point. While this chart may indicate overbought and oversold conditions, an equity can remain in these conditions for a while. And bear in mind, buy and sell signal indicators are speculative in nature, right? And so essentially what they're saying here is, we get this buy signal, all right, and we start to move up here. And then at this point, we get the sell signal. Or now we don't see a strong move to the downside, but you see that the momentum has really died off here and we really started to consolidate, right? And then over here, we see it cross back up above and we end up getting a new momentum trend to the upside. And then here we see it cross back down below and we start chopping and moving more sideways again, right? So that's essentially how you would use the shaft trend cycle. These are just two indicators that you guys can look at possibly using to help you guys out on your journey, that are different from just the regular old RSI and MACD. Those are really some of the basics, and these ones are, less known. So I wanted to make a video on them, kind of show them to you guys and, just give you guys some different ideas of things that you could potentially use. So that's it for today's video. Smash that like button, subscribe to the channel if you guys are new, and I'm out.